Why should you invest? Chapter 1. Need to invest. Simplified explainer. Let's start with a simple question. Why should you invest? Most of us earn, spend, and save, but very few of us invest. Now imagine this. You earn 50,000 rupees every month. You spend 30,000 rupees on your daily needs. Rent, food, travel, shopping, all that. That leaves you with 20,000 rupees in savings every month. Now let's say you simply keep that 20,000 rupees as cash, no investments. Let's see what happens next. Let's make a few simple assumptions. Your salary grows by 10% every year, but your cost of living, your expenses, also increase by 8% every year. You're 30 years old now and plan to retire at 50. You don't work after retirement, and you simply keep your extra 20,000 rupees as cash, no investment, no interest. Now, if you go by this assumption, after 20 years of working hard, your total savings will be around 1.7 crore rupees. Sounds like a lot, right? But here's the problem. After retirement, your expenses will continue to rise, and that 1.7 crore rupees will last you for only about 8 years. After that, you'll be left with nothing. That's a scary situation. So, the big question is, how do you make sure your money doesn't just sit idle, but grows? Let's change one thing. Instead of keeping that money idle, what if you invest it, say, at a return of 12% per year? In the first year, you save 2.4 lakh rupees. If you invest that amount and let it grow for 20 years at 12% annually, it becomes over 20 lakh rupees. Now, if you keep investing your yearly savings this way, your total corpus after 20 years won't be 1.7 crore rupees anymore. It'll be 4.26 crore rupees. That's more than double, all because you chose to invest. So, why should you invest? There are 3 strong reasons. To fight inflation, prices go up every year, and investments help your money keep up with inflation. To create wealth, investments multiply your money over time. To achieve a better life, whether it's buying a house, your kids' education, or a comfortable retirement, investments make those goals possible. Now that we know why investing is important, let's move to the next question. Where should you invest? There are different types of investments, or as we call them, asset classes. Think of each asset class like a vehicle. Each one moves at a different speed and has a different level of safety. Let's understand the 4 main types. 1. Fixed income instruments. These are investments that give you fixed returns and keep your capital safe. The most common example, your bank's fixed deposit FD. You invest a certain amount for a fixed period, and the bank gives you interest. Government bonds, T-bills, and corporate bonds are other examples. As of now, FDs give you around 5 to 6% returns, government bonds around 5.5%, and corporate bonds may offer 9 to 10%. But remember, higher returns mean higher risk. Government bonds are safest, while corporate bonds can default and become worthless. So, fixed income investments are safe, but they don't grow your money fast enough to beat inflation. 2. Equity, stocks. Equity means buying shares of companies listed on the stock exchange, like BSE or NSE. There's no capital guarantee here, but the returns can be much higher. Historically, Indian equities have given 12% or more annual returns over the long term, and the best managed companies have even given 20% plus KGR returns. Of course, investing in equity requires knowledge, patience, and discipline. But if you stay invested for years, equity is one of the best wealth creators. 3. Real estate buying property is another traditional investment option. Plots, flats, or commercial buildings. Here, you can earn in 2 ways, rental income and capital appreciation. However, rental yields in India are usually low, just 2 to 3% per year, and property prices don't rise uniformly everywhere. Also, real estate investments need a large amount of money and come with legal formalities and liquidity issues. You can't just buy or sell instantly. 4. Commodities, mainly gold and silver. Gold and silver have been traditional favorites in India. Over the long term, they've given 5 to 8% CAGR returns. You can invest in them through jewelry, ETFs, or sovereign gold bonds, SGBS. They're relatively safe, but returns are moderate. Now let's go back to our earlier example. If you invest your money for 20 years in fixed income, say 9% return, your corpus becomes 3.3 crore rupees. In equity, 15% return, it grows to 5.4 crore rupees. In bullion, 8% return, it becomes 3.09 crore rupees. Clearly, equity gives the best long-term results. You might wonder, what about cryptocurrencies? Well, crypto is still unregulated in India, and when you invest your hard-earned money, you need safety nets, rules, regulations, and protections. Since crypto lacks that framework, it's best to stay away until there's proper regulation. So what's the right approach? Don't put all your money into one type of investment. Instead, diversify across asset classes. This is called asset allocation. For example, a young professional can invest 60% in equity, 20% in precious metals, and 20% in fixed income. But a retired person may prefer 80% fixed income, 10% equity, and 10% gold. The mix depends on your age, income, and risk appetite. Finally, a few things to remember before investing. Risk and return go hand in hand. Higher the risk, higher the potential return, and vice versa. Fixed income protects your capital, but might not beat inflation. Equity can be volatile, but helps you grow wealth faster in the long run. Real estate requires large investments and has low liquidity. Gold and silver are safe, but offer moderate returns. So, if you want your money to work for you, investing isn't an option, it's a necessity. Start early, stay consistent, and watch how small, disciplined investments today can turn into financial freedom tomorrow.